Our next guest thinks the risk reward for equities is skewed positive for the year. Trivariate Research CEO Adam Parker joins us now. A rare appearance, not with us, Adam, and we miss you. We've been talking earnings with Mike, and it's something we've discussed oftentimes. I'm curious. My recollection is you were not particularly sanguine for earnings growth in 2024. Is that still the case? And if not, why not?
Yeah, we're using a few percent growth. You have a good memory. We think the earnings will grow. We actually raised our numbers by 5% from a year ago. Almost all of that was driven by the biggest 20 or so companies, which have just shown an incredible ability to expand their net income. The reason I'm positive, I think the skew on equities is positive, is threefold. One, I do think the average company can have gross margin expansion. And I think that usually is associated with equities going up. Two, I think there's a reasonable case to be made that there'll be some accommodation from the Fed and or other big central banks later this year. And I don't know if I've learned that much in the last 30 years, but I think one of the things I learned is don't fight that. And then the third thing is I think maybe earnings could grow many years in a row. And a little bit like in 2011 when things looked expensive, if we end up with multiple years of a little bit of earnings growth, we'll end up thinking that equities are attractive. So I could see the skew being a little bit more positive than the consensus. And we've been out marketing our year ahead outlook note and gotten enough pushback that leads me to believe we don't have, totally consensus views there.
Yeah, but what changed then, Adam? I mean, I can't again remember conversations we had earlier in 2023 where you were not looking for any growth over perhaps not just a 1 year period, but even a 2 to 3 year period in terms of earnings.
Yeah, we had sort of thought maybe 24 earnings could be flattish with 23, and we just raised them by 5% versus a year ago. And all of that's driven by the biggest companies, and I think a little bit of the trough in gross margins for the average company. A lot of it has to do with the big change in CPI. There's a statistically significant relationship between the changes in CPI and the changes in forecasted gross margins for the median company. So if you get less inflation, the average company can do better. The big companies, it doesn't matter. They can pass on pricing and they're good at absorbing costs. But the average guy looks in better shape now, too. So it's not like I'm a uber bull on earnings. I think the bottom up numbers still have to come down some. But I think you can have, mid-single digit earnings growth this year. That's better than maybe I thought a year ago.
Adam, I mean, you mentioned 2011, which is, kind of a hopeful moment. You actually were also flat for 2 years at the low in 2011 versus, the first rally off of 2009. But you mentioned that things looked expensive then. I mean, I think we were in the low teens in terms of a PE on a forward basis for the S&P 500. So how does that square?
It's more just that you could be concerned. And then if earnings grow for multiple years, what makes equities work is in the middle of this year, we think earnings are high 5 to 24. At the end of this year, we start launching 26 numbers and they look ahead of 25. And all of a sudden you kind of look at the upside you need to justify. I mean, right now to get 5,200 S&P or, 10% plus upside, you need to pay 20 times 25 earnings at the end of this year. And maybe, that starts looking more attractive as you go forward. So I think it's that kind of logic. You remember in 2011, everyone thought, earnings were going to be massively impaired. Europe was blowing up. And then all of a sudden there was a lot of accommodation and things worked. The struggle I have when I look at historical accommodation is from the Fed is it always came in a crisis, or at least in the last 25 years, right? TMT bubble correction, global financial crisis, COVID. This doesn't feel anything like that to me at all. Maybe you get a bit of a, sort of tweaking from the Fed. So I don't think they're going to cut anywhere near as much as what's in the price. But I think directionally they're more likely to cut than hike, and that's generally been supportive of equity multiples.